1985, the Government of Canada accepted a proposal for the creation of a service medal for all full-time and volunteer members of the numerous components of Canada's fire service. Regulations of this paralleling those of other exemplary service medals were drafted. For the medal was forwarded to Her Majesty Queen Elizabeth II. The Queen signed letters patent creating the Fire Service's Exemplary Service Medal on August 29, 1985. The design of the medal incorporates crossed axes, a hydrant, and a stylized Maltese cross, an internationally recognized symbol of the fire prevention community. Both are superimposed on a maple leaf, the standard background symbol of Canadian honors. The red of the ribbon represents fire. The gold, common to all exemplary service medals, represents the quality of the service honored. Members of Canada's fire service are sometimes unappreciated, despite the often dramatic and widely publicized circumstances in which they perform. Their profession, more than most, is truly one of long periods of tranquility punctuated by moments of stark terror. The recent Fort McMurray fire goes a long way to remind us of this. Far too frequently, we sit in awe watching a spectacular fire without thinking about the people whose duty it is to fight that blaze or what is really involved. Nor do we consider that fire is the Fire Service's Exemplary Services Medal honors members of a recognized Canadian fire service who have completed 20 years of service, 10 years of which have been served in the performance of duties involving potential risks. Further service is recognized by an attachment of bars. Exemplary service is characterized by good conduct, industry, and efficiency. Tonight is my honor to recognize two members of our community who symbolize dedication and involvement in our fire protection activities. Trevor Cicerowski has been a member of the High Prairie Volunteer Fire Department for the past 20 plus years. In that time, he has progressed to Deputy Fire Chief and become an integral part of the community. Many of the structures and equipment additions that the fire department uses are a result of Trevor identifying the need and creating the solution. He has spent many hours creating hose drying towers, equipment store solutions, and other innovation. But part of any solution to a problem is finding the dollars to purchase the material. And in our fire chief, Ken Melnick, Trevor has found the perfect partner. Tonight, Ken is receiving a 30-year bar, recognizing his long commitment to our fire department. The fire hall next door is Ken's second home, as I am sure his wife, Julie, can attest to. And as with any second home, Ken works with Trevor and the rest of the fire department team to ensure that the best equipment, information, and practices are in place for the protection of the volunteers and our community. Tonight is an opportunity to say thank you to our fire chief, Ken Melnick, and our deputy fire chief, Trevor Cicerowski. Thank you, and could you step forward and receive your honors? Trevor first because he's receiving his medal.
Okay.
And here you are. And
I'll let baby take yours first so we're not all looking at different cameras.
okay. Get it?
Oh, you're done already? Okay.
All right. And
Okay, just Tim, so I can see the medal a little bit more, please. Okay, thanks. And I'm going to take you and do a test. Okay, great. Thanks so much. Congratulations, Trevor, and thanks.
what is this one for?
12 years? Cool. Okay.
Wow.
Thank you
And
very
I have
much.
a certificate and I have a pin for you, but I'll get them to you later.
Awesome. Thanks, man.
Congratulations.
Thank you.
Congratulations.
You have to come around this way,
I gotta come around this way.
Stop quickly before she jams it. Big gambit of bronze.
Congratulations, Trevor.
Thank you.
Same for me, 2 each way.
Come down our side this time. Mine was being spoiled. That's his reward. He doesn't have to stay. His reward's good to go.
Thanks, congratulations, Ken.
I don't know, how do you make it go? How do you make it go?
Ready? Yeah. Call the order right away.
Oh, there it is. Oh, yes, it's getting brighter.
You're all ready?
There he is.
Call the meeting to order at 7:30. Introduction of the agenda.
I move that we adopt the agenda as presented.
Any additions? All those in favor? Welcome to our scheduled.
Great, if it's carried.
Can we get the microphone?
Welcome to our scheduled delegation, Mr. Michael F. with Hawkins F. Dumont. And we'll let you take over and present for us.
Okay, good evening, everybody. Pleasure for me to be here. It was a nice drive up from Edmonton. I always come the Swan Hills way because you can reach an altitude of 1,268 meters on that road. I don't know if you knew that, because the high point is just past Swan Hills, which is kind of neat, and it's a nice view. And honestly, the sky was clear. I was expecting smoke. I was expecting, that, and too much of that, is, of course, has been around Alberta these days. But thankfully, it was a lovely, clear day. So, pleasure to be here. Get a chance to report to Town of High Prairie. This is our first year doing your audit. You appointed us this past year. I came and met with council in June. I think I met some of you. Some people are new as well. So since then, we've done the audit. We're filing. You're filing at the end of May. Normally, it would have been filed at the end of April. There were some delays in getting some of the work done, due largely to some of the turnover in staff. I think you're aware of that. But nonetheless, we got everything done, and really appreciated Terry's help. Terry and Brian, I came in today, we had a meeting with them as well, but they were very helpful with our staff that were performing the audit. So, thumbs up to the hard work of your finance team to get things together so that we could complete our work. So it was good. It's good to be here. I'm going to give you a PowerPoint presentation, so I'm going to refer to this presentation here, and everybody can see that okay, and that's really my purpose tonight, is to review the statements using this PowerPoint. The first report in the statements is the auditor's report, and it makes reference to various things, and rather than reading the report, I'll just tell you a little bit about it. So the audit report identifies the scope of the engagement. It talks about management responsibilities, and when an auditor refers to that, what we're saying is that it's management's responsibility for the accounting systems and procedures that are in place here in the town in order to account for all the transactions, and thousands of transactions throughout the year, and that's all part of the responsibility of management. And the financial statements that have been prepared, even though we prepared them, they've been prepared from your record, so they're your financial statements. The auditor's responsibility is to conduct the audit, which is what we did. So auditors follow Canadian auditing standards. And those standards, I've given a few bullet points here. Some terminologies that are used: reasonable assurance. So we're not looking for absolute assurance, we're looking for reasonable assurance. So we audit, we do a materiality calculation, we determine what we think is the sensitivity of the figures, and we assess that, and again, all commonly part of the audit process. In fact, auditors use 2% of revenue as the materiality scope, and then that's used throughout the audit process. What we're determining is that the financial statements are free of material misstatement. That's our objective: free of material misstatement. And we do our work on a test basis, so we sample transactions throughout the year. And we cover all the various transaction streams, and you think of it in any organization, but particularly a municipality, you think of purchases, payables, payments, that's a transaction stream. The tax roll, determining tax amounts, issuing tax assessments and collecting taxes, that's a transaction stream. Payroll, imagine the number of people that are on payroll that have been paid throughout the year, all the stream from hiring to maintaining the personnel records, receiving hourly amounts or numbers of hours that people have worked, their hourly rates, their monthly rates, all that information, that's a transaction stream. So the auditors test transactions in that. And also, of course, tangible capital assets, TCA, is always a large balance in any municipality. And there's certain estimates that are made in your financial statements. For example, amortization. When you amortize your capital assets, that's an estimate of useful life. So those are various judgment calls that are made, and we assess those. So finally, we were able to issue, and will be issuing a clean, clear audit opinion. These financial statements that you're looking at tonight are stamped draft. So after tonight's meeting, once they've been approved, and we will finalize, sign, and they'll be issued to municipal affairs in the correct timeline, which in your case, you've asked for an extension to May 31st. So our final opinion paragraph issued, and it was issuing a clean, clear audit opinion. So that's our report. That's really our contribution to this whole process. What I'm going to review with you now is the financial statements. And I always carry with me a handy laser pointer. You never know when you're going to do a presentation, and you want to have one of these with you. So I'm going to give you a little bit of the highlights here. So here's the town's financial position at December 31, 2015. And the importance of this schedule, this is financial position. The importance of this schedule is this line item right here, net financial asset. So your net financial asset position at the end of the year was $1 million, $1,028,000. Last year was $2.4 million. And as you can see, the figures are, it's a mathematical calculation of total financial assets less financial liabilities equals the net financial position. And then the rest of the financial position is your tangible capital assets. I mentioned all municipalities, it's always a large number. You've got $45 million worth of net book value in your tangible capital assets. So let's just look at these individual line items here. So cash and cash equivalents. So the balance last year was about $6.4 million. This year it's $5.6 million. So the cash balance has gone down. You spent about $4.6 million in tangible capital assets this year, and that's utilization of your cash. Last year you spent about $3.2 million. So you've spent more money this year on your tangible capital assets as compared to prior year. And of course, other components of the cash and cash equivalents is the actual cash from operations, less additions to capital assets, and then your debt repayments. Your debt repayments are about $316,000, so all of that comes out of the cash. I should also mention too, just to remind everybody, these are consolidated statements. So you pick up your proportionate share of the High Prairie Municipal Library, the High Prairie and District Regional Recreation Board. We just had that meeting half an hour ago, and also the High Prairie and District Regional Solid Waste Management Authority. So you're picking up the investments, and they're added on to your balance sheet. So these numbers are a combination of your numbers, 100% your numbers, plus your proportionate share, your percentage interest in those entities. Okay, well, let's move on down the list here. So as you can see, taxes, grants in lieu, balance is $224. This year was $150,000 last year, so some balance increase over prior year. Trade and other receivables, $1.4 million this year, $1.6 million last year. One comment I can make here, this included in here is natural gas sales, and your sales were at the end of the year, it was a warmer winter overall compared to 2014, and the actual balance in receivables at the end of the year is less as well. Gas prices were less than prior year, so that's an explanation. These investments have gone up compared to prior year, and that's largely due to the Waste Authority, and again, picking up your share of their investments. Okay. On the liability side, $936,000 worth of payables. Last year, the balance was $1.2 million approximately. The decrease prior year is largely due to the fact that there were certain holdbacks outstanding at the end of 2014 that were not outstanding at the end of 2015. I always mention to clients when we were talking financial position, we're always talking a snapshot point in time, December 31. So it's just that one day, you know, what was your balances at that one day. This is an interesting change over prior year. Deferred revenue. Very common to see deferred revenue in any municipality. Generally, it's when you receive grant monies that you have not yet spent. So you've received them, but you haven't spent them, so they remain in deferred revenue. Well, this year, you received a large amount particularly in your MSI grant, and you received about $4 million, and you spent about $2.7 million, and so there's a $1.4 million roughly going forward into next year. And if you can remember the projects, and you'll see this coming up again, the lift station, paving, West Fraser project, there's a further listing coming up too. Landfill closure, post-closure, you are obligated in this regard. You had a landfill, it's been closed, but you're then now part of the local authority, waste authority, and as such you have to pick up your share of their liability, and so this has been recorded, and this is an estimate of closure and post-closure costs looking into the future based on engineering studies, assessments, length of life of the waste authority or the particular cells, that are used. Long-term debt, there was no new debt. You've paid off, making your payments. It was $4.3 million last year. Now the balance is about $4 million. You paid off about $300,000 over prior year. And TCA, so that takes care of your net financial asset position. Now these other components, largely tangible capital assets, $45 million compared to last year, 42. And in a few minutes, seconds here, I'm going to show you the next slide and we'll pick that up. But keep in mind here, this represents net book value. If any of you are in business and you're familiar with your own company's financial statements, you buy an asset, a tangible asset like bricks and mortar, equipment, vehicles, whatever, and then you amortize them. So this represents the expenditures made by the town and then amortized. And these were first put on your books in, I think, 2009. That's when the requirement became applicable for municipalities to record tangible capital assets. So they've been amortized. But keep in mind that the costs in here are not price value adjusted. So a motor grader purchased 10 years ago certainly costs less than a motor grader purchased today. Yet you might have one in here, and I'm just using that as an example. You might have a motor grader in here that's 10 years old that has a purchase price different from the one you bought this past year. But nonetheless, those costs are simply added together regardless of when they came into your books. Overall, your surplus at the end of the year is $46.3 million. Last year it was $45 million. So let's go on to the next slide. Here's a bit of detail about the net book value of the tangible assets. Here's the category. So engineering structures, that's generally, usually the largest category of asset that a category of tangible capital assets that a municipality has. And you can see the changes over prior year for various projects. Again, net of amortization. Buildings are about $20 million. Last year it was 17.8. Land and land improvements, slight decrease over prior year. And that would have been for amortization of the land improvements. Machinery, equipment, no significant change. Vehicles, no significant change. Construction in progress, so this was in progress last year. That's now been allocated to the appropriate categories. Likely a majority of it went to engineering structures. So that is tangible capital assets. And then here is the actual additions that you made during the year. And you can see the different components. Lift station number 4, that was a replacement. This is an upgrade. $2 million there, $300,000 here. High Prairie School building, $385,000. And I'm sure you're well familiar with these different named projects. You've seen them in council minutes throughout the year. So that's the accumulation of those expenses for the year. Okay. So that's financial position. Now we're talking operations. So now we're going to discuss the actual, revenue generated in the municipality this past year. And as you can see from the numbers here, your user fees and sales of goods were about $4 million this year, $4.6 million last year. And your what I can comment here, just some comments that I have. The school requisitions, there was a greater amount collected than was levied, and so there'll be some adjustment for that into the 2016 year. But otherwise, you're pretty consistent with the budget here on your this figure, 2.9 million. Your budget was 3,025,000. So your net municipal taxes were very close to budget. User fees, 3.9 million actual. Last year was 4.6. Decrease is consumption and also the rates of natural gas, warmer weather. I've seen this kind of trend with other municipalities that have a gas utility or that are buying and selling gas. They also have shown revenue reductions as a result of both quantity, sales, and also pricing. So that's largely the explanation there. Government transfers. So here your transfers are 690,000. So this is operating grants. Your budget was 335. And your actual last year was 761. Comments here. That's government. These government transfers. Remember, they're including the consolidation. So the consolidation of the library, the rec board, and the waste authority.
So is the budget amount you referred to, that's only the town's budget amount?
It is.
Oh, okay.
So other categories here. Let's look at franchise. That's pretty good. That 183, budget was 170. So those are more or less the larger categories overall. And so you see the overall revenue of 8.3 million, 8.3. The overall budget was 8.4. But correctly, as there are some categories in here that your budget it's only your budget. It's not necessarily the other entities.
Once you consolidate the other entities, at what do you review their financial statements to ensure that they are in a good financial position?
Well, yes, we do. We audit the Recreation Board, and we audit the Waste Authority. We don't audit the Municipal Library, but we've seen their audited financial statements. So we obtain all of that information.
So if anything is out of whack on that, you would let us know that.
Certainly, if something looked odd. Okay, so that's revenue. This next slide is we could have used different brighter colors, but we're accountants, so we aren't that creative. But you can see here, what's important here is these percentages. So your net municipal taxes are about 34% of your total revenue dollar coming in. Sales user charges about 48%, again, consistent with prior year. Government transfers, consistent with prior year. So definitely the revenue sources received this year compared to prior year are consistent in their components of the total dollar. And here is a bar graph, and it does show that revenue is higher, lower than prior year, but the components are about the same. And remember, where that reduction occurred is largely in this sales and user charge category, this category here, and that was as a result of the natural gas. Okay, so let's look at expenses. So expenses, the presentation we have here shows by object, and the objects, the nature of the expenses when we call by object. So materials, goods, contracted services. So this would be all of your, certainly your maintenance of your facilities is part of this cost. And you can see compared to prior year, 2.9 this year, 2.7 last year, 6.2% increase over prior year. Salaries, wages, 2.7 last year, 2.8 this year, 2.9% overall increase compared to prior year.
What would be the rate of inflation for last year?
Generally 2% is what I've seen in the literature is, you know, it may be different for your province or your particular community, but generally 2% is what people assume in calculations. Transfers to other governments, so 619 versus 645. Again, pretty close to prior year. Contracted and general services, $1,064,000 versus $1,008,000. This is where your natural gas purchases are. So general services there. So that's helps to explain why that is down over prior year. Other categories, and then your amortization. So again, amortization is a category by itself, and that's the amount that's been charged against your tangible capital assets. Let me just add a couple of comments. I don't have a slide for this, but I have some comments about your different function codes. So when your actual financial statements reports the different functions, like planning, development, gas distribution, things like that. So I'm just going to read some notes here. Unfortunately, I don't have a slide for this. But gas distribution, your revenue, your gas distribution expenditures, your actual expenditures this year was about 1.5 million. Last year it was 2.1. And of course, reduction is consumption as well as gas rates. And you budgeted through 2.4 million. So you budgeted in accordance with anticipated, 2014, and they were less. But of course, they're also less on the revenue side too. Recreation and culture. Here you budgeted $1.3 million. Your actual is $2 million. And some comments here. The town does not budget for the rec board or the library salaries. We know that. So there's some explanations there. But overall, recreation and culture was very close to prior year, like within a couple $1,000s of prior year, 2014. Other larger categories, wastewater services. Here your actual was $634,000. Last year was $532,000. So that's up about 9% over prior year, but it's consistent with budget. Water services, very close to prior year, very close to budget. At $1.5 million, so very close to budget there. Roads, streets, equipment, the single one of the largest categories there. Again, you're very close to budget. Budget was $1.8 million, actual is $1,741,000. Prior year is $1,730,000. So again, very close to what you had planned and very close to prior year. Okay.
Do you not see that often with the recreation and culture with the reason for joint groups that were funding, like that budget amount should have been so much lower than the actual, when our actual in 2014 was very close to.
I think that not all of our municipalities are in a situation. Your situation is unique in that you've got 3 different entities that you are actually proportionately consolidating, and I don't know whether in the past you've included your budget, those entities. Generally speaking, they're not added onto the budget numbers; they're just part of the actual numbers, which brings up a good point. And Terry and I talked about this, and Brian, is that some municipalities actually show in their financial statements, they'll show their own entity by itself. So they'll consolidate it as appropriate, that's correct accounting treatment, but they'll also have schedules in the financial statement to show financial position of just their entity, and then their operating revenues and expenditures, just their entity. So it makes it a little bit awkward when you're explaining budget to actual, when you look at a published, your final document, which is consolidated. This is likely the first time you've seen these consolidated numbers. Throughout the year, you just see your own entity, you just see the town. But for financial statement purposes, for purposes of public disclosure, they need to be consolidated, and that's when this consolidation process happens. That's really all I can say. It does cause a bit of difficulty in explaining actual to budget. Okay, but those are some comments on the overall. For example, in the statements that you see here, $9.7 million is the actual expenses. Your budget was $9.9 million compared to 9.7, and the prior year is 10.3. So those are.
So the budget did not include the other entities?
It didn't as well, and as well it didn't.
Expenditures did.
Correct.
This is why Brian and Michael and I discussed that this afternoon. I knew that there would be a problem. And so I have asked Michael to give us a estimate of what it would cost us to have two financial statements, the one with the schedules that have the entities separate and the consolidated. It'll give you guys a much better guideline as to how you were to budget, how you did your portion of just municipality. And the consolidated, like Michael says, are the ones we have to legally forward to the province, but you'd also have a showing of what is just the town.
Who did the budget number, Terry, then for the 2015 recreation and culture? Is that a combination of libraries budget and like their, like, where's the number from? I'm so confused.
This office doesn't have anything to do with the budget for the recreation board or the library board or
I mean, we
the.
get their actuals, so I get that, but where did was it just their presentation of their budget numbers that we just stuck together to make this $1.3 million budget? You don't know?
I don't think their budget numbers are included in there. Your share is not included in that budget, but the actual is.
Well, what is that budget number then? Am I confused? Like, understand what that budget number comes from?
Your own budget. What you budgeted as a town.
Yes, the town's portion of the recreation, the town's portion of the, but then the expenses are also over the town's portion too, aren't they?
No, the expenses include your proportionate share of those entities, the library, the town.
Yeah, so it's just our portion either way. I don't know how you come up with that. I just made a note saying something funny about that number, but.
I mean, it's not that relevant. It's not working. Okay.
And so, going forward, certainly something.
Now, the next slide is that same picture.
Okay, this slide here is, again, percentage-wise, and you see the components. So materials, goods, and utilities, this year is 30% of your total dollar. Last year it was 28. Other is 29, 25. Salaries, 29, 28. Contracted in general, 12 this year, 19 last year. So you can see pretty good consistency on your main categories of expenditures compared to prior year. Again, the total dollar of expenses. And the same information on a bar graph, and you see the totals are pretty close to prior year. So there certainly is consistency. I mean, I see that. We see a lot of municipalities through the course of our audits, and this demonstrates good consistency with prior year. The next category I wanted to show you is the annual surplus. So overall, your operating, so revenues less expenses from your operations, again with those consolidated numbers, is a deficit of $1.4 million. But then when you add in your government transfers for capital, so this is the government funding for capital, you end up with a surplus of $1.2 million. Last year your surplus was $2.8 million. Last year also, you might remember there was a sale of land in 2014, and that generated a gain of close to $500,000 in the prior year. And then the surplus of $1.3 million compared to 2.8, so then it's added on to your opening accumulated surplus. There was a change in accounting policy that we identified during the audit. This has to do with local improvement levies and the accounting treatment for that, and so that adjustment had to be made to your financial statements. So that actually increased your, it was an addition to your surplus. So you ended up at the end of the year with a surplus of $46.3 million. Last year it was $45 million. That particular change in accounting policy is described in a note into the financial statements. It gives explanation of what that was. And that was a change in accounting policy that we identified during the year.
Does the town have a policy for local improvement levies, or would you know that? Other than for developers, like, let's say we were doing a street and we were doing sidewalk improvements. Would the taxpayers on that street pay for that sidewalk, or do we amortize that throughout the whole town?
And that would be amortized against them properties on that street.
So they actually get a levy on it when we do something like that, specifically?
If that's council wishes.
Oh, okay.
Rather you take it out of
Okay.
the-
So when we went back and did those walking trails, that came out of the grant?
Yes.
That did not go to the property owners? Okay.
This particular levy that we're referring to here is, I think it dates back to maybe even 2008.
2008, correct?
Okay.
So I can't describe what that project was, but clearly you identified a project for specific ratepayers and then they were levied separately.
There is one of the local improvements that is paid off this year with the taxes, and so they will not be on the next year's taxes. It's paid off, but there's 2 or 3 of them that are in the works right now.
Okay, so that's your surplus. This is your accumulated surplus.
Yeah, you folks are much more adept at this public speaking than I am, so you know about the
I
microphones.
can hear you then.
Okay, okay. So your overall, there's that overall accumulated surplus, $46.2 million. This structure here, where you see an unrestricted amount of 9.4 million and a deficit restricted amount of 4.2, that's unusual. Last year it was 2.8 and 4. Now these still balance to 46 million. That's still the right number. But we've discussed this with Brian and with Terry, and they will be working with you in the next couple of months to make an adjustment and ultimately to identify the specific projects that the surplus has been set aside for. And there will be an adjustment to balance this out more like what was done in the prior year. Okay, but that's the way your statement has been presented. You know, it's accurate. It's just that there will be certain adjustments made between these two accounts.
I'm not following that. Is that because we've moved into identifying which funds they go into, and previously it was one big fund and now it's specific funds? Is that?
You know, this is the way your general ledger recorded these balances. We've audited to these balances, but there is going to be some reclassifications. It's really an internal matter as to how you identify that surplus, the unrestricted of 9.5, and how much of that you're going to allocate down to cover this deficit. What Terry will show you as she works with you, she will be working through either past council minutes where you identified certain drawdowns that you made from your surplus for different capital additions. But what's missing here is the approvals to transfer monies from unrestricted surplus back to restricted. That's what needs to be worked on, and that's really an internal matter, and that's what's going to be dealt with in the next little while. And then your financial statement, what I would recommend, and I've seen this in other financial statements, is that in your statement there actually be a note that identifies the different reserves that you've set aside, the different projects that you have earmarked for these surplus funds. Okay. So that's the detail. The summary of our comment is that you have an excess of $1.2 million overall compared to last year, 2.8. Your net financial asset position is $1,028,000. Last year it was 2.4 million at this time. Just to remind everybody, what is net financial assets? What's the measure of economic resources required by a town to provide services into the future? So that's the general nature of that net financial asset number. And a final thank you to management, to Brian and Terry and the staff, and certainly appreciate being able to report this to council today. And we'll finalize these statements after you approve them, and then they will be, we have to issue what's called a FIR, which is a financial information return, which is the actual government document, and that's the one that'll go to the government by May 31st, and which represents your filing. And you had requested an extension to file at May 31.
So with our net financial assets being $1 million less than 2014, is that a concern, or is that okay?
The key thing is that you're in an asset position, so you're in a positive position. The fact that it's down from prior year is not of a particular concern. It's a matter of going forward and how you are funding projects going forward. you have a cushion, somewhat of a cushion of $1 million. That's the way I would read this. But remember too, you're still carrying your overall, your debt balance. And this is something that people should keep in mind. In fact, I'll just go back, well, I'll go back to the slide, but a little hard to get to. It's your total debt's about $4 million. That debt has been deducted in arriving at this net financial asset, but that you will not pay off $4 million next year. You'll pay off about $300,000. So it's a matter of managing your cash flow, managing current projects to properly utilize the cash that's available to you, whether through grant money or through your other sources.
Okay.
So it's a reduction. Yes, it's a reduction, but it's not something that would I would say is a concern.
It's cash management, so if using this and grants that we can apply for and are successful, and other methods of accumulating money, then we apply that to however many projects we plan on doing in the upcoming year. So it's kind of a planning exercise, but you really do need some excess.
It's only prudent to have some excess.
It's just a question of how much excess.
That's correct.
Okay.
Do you have access to previous years or only 2014? Like you're saying we're paying off our long-term debt at about $300,000 last year?
Yes.
Is that a consistent practice that you've been able to see, or is that just a number from is that the only year that you're able to?
No. The figures that we have on your debt repayment are consistent with your debentures. So your debentures, page 18 of the actual financial statement, shows that your principal payments are in that $300,000 plus range, $300,000 to $400,000 range, but you're paying interest as well. Your total debt repayment is about $540,000 of total repayment, principal and interest. So that's what you're budgeting for, and then that's your amount going forward and the debentures that are outstanding, they will mature between 2021 and 2029. So really for the next foreseeable future here, I've got figures here for 6 years. Your amount being paid every year is about $540,000, of which the principal is between $350 to $400, and the balance is interest. And we do have access to your prior year information is public knowledge, public information available on the government website, and we have prior year information from the other auditors as well.
When you're auditing, do you take that into account though? Do you look at prior years?
Yes, we do. Yes, we communicate with the former auditors and we obtain their working papers to help us pick up where they left off.
The interest rate we're paying is between 4.85 and 5.86. Isn't that kind of high for debentures?
Well, it's certainly higher than what you could go and borrow today at. But these are debentures. These are long-term financings. Terry, maybe have a...
Yeah, through the Alberta government, and they were supposed to be set up to be very good rates. And I think the treasurer has a comment.
We ran into the situation at one of the other municipalities I was at. When ACFA first came out, the rates were about 10% lower than you could get at banks or whatever else type of thing. So they were the preferred method of choice. Over the years, their rates have not changed that much because they take a little bit of risk into consideration and they want to make a bit of profit and stuff. The banks in the meantime have gone down dramatically. So the government has put in a thing now that you can go to banks or to ACFA, whichever you prefer as a municipality. So the job is for the treasurer, whenever you guys decide you need a debenture for something, to check out what is best, what is the best rate, but you can't take just the best rate into consideration. You also have to take the factor of repayment schedule. If somebody wants to prepay on something, they can very easily with ACFA, and depending on the penalties on banks, that might not apply. So there's other things to be taken into consideration too. But yes, the rate does seem high compared to the banks nowadays.
Are we allowed to prepay any of the debentures that are outstanding now?
Yes.
So we could pick and choose and say, these 5.86, let's
But I believe there are penalties
Yes, there are.
Oh, there's still penalties?
Oh, yes, there's
With
still penalties.
ACF? Oh, okay.
I would say the majority of our municipalities are borrowing from Alberta Capital Financing Authority. That is the normal source of municipal funding.
The ACFA did not have penalties, just to add on, did not have penalties originally. That was something I believe that only came into effect in either 2011 or 2013. And now they're more consistent with everybody else, but for a while there was no penalties.
I just wanted to ask, like, you guys go through and make sure all of the processes are being followed, right, and all of the town's policies?
Yes.
And you found that all to be consistent, no big issues with that?
We raised some points, call it internal controls. Overall, we didn't find significant deficiencies in your internal controls, but we have made some recommendations for some specific areas. I call it best practices, just based on things that we've seen in the marketplace that we're recommending to you. So overall, we were satisfied, and it was recognizing that it was a year of transition, and so it was more challenging to follow that through because of their differing finance managers in particular. But we were satisfied in the end that we were able to say that your accounting systems did not generate significant deficiencies. Nonetheless, we are making some recommendations for some areas to work on, again, best practices.
And those are just with administration, they've got those recommendations, because I don't know if I saw them in here.
They're not published in the financial statement. There'll be a letter coming to council that's referred to as an audit findings letter, and that letter will make some reference to some of these points, but then also there's a separate letter that is going to management, and council has authority to look at those letters as well. But there is a separate letter going to management, which has more of those detailed comments.
And one, it's a small detail, but just in the first page when you were doing the letter to us, and under other matters, the very last paragraph, it says that the other auditor who expressed an unmodified opinion. I'm just curious what unmodified opinion of those statements mean. What does that mean?
Unmodified means that they issued a clean audit opinion. So they did not modify their opinion. It was a clean opinion, similar to the opinion that we're issuing.
Oh, okay.
It's just appropriate that we refer to it because it was not our firm, it was somebody else.
Yeah, I just didn't know what unmodified meant.
I believe the terminology that used to be used was qualified and unqualified.
Okay. Yep.
The amortization rate, what percentage are you recommending for budgeting purposes? Well, I'm just wondering.
Well, you actually don't.
You don't do a percentage.
You don't budget for amortization, but the usage, the rates that you use are disclosed on page 15 of the financial statements, where you identify to the reader that you use a straight line amortization and you've selected useful lives and they vary. So it's actually not, I'm not going to be able to quote percentages, but for example, on buildings, you're amortizing between 15 to 50 years on buildings. Engineering structures, 20 to 50 years, machinery and equipment, 5 to 15 years, vehicles, 10 to 25 years. So these, in effect, you could work these into percentages. Those are the rates that you're using. That's the way you're amortizing your assets.
And is that what we did last year, or?
Is that what we did last year, or is this different? Nope.
These are the same.
Same as what we did last year.
Council put forward a policy a number of years ago when the TCA first came to effect, and they have, that's a 12, 13-page policy that has all those rates and details in it, and 90% of it was copied from what the province recommended to all municipalities.
Oh, okay.
So is it your opinion that these are reasonable amortization periods?
Yes.
Yeah, and a process.
We work with a number of municipalities. These are very commonly used incorrectly. Municipal Affairs did give guidance to municipalities in 2009 when they were doing this for the first time, and they gave recommended rates. But buildings 50 to 50 years for 50 years for bricks and mortar, cindercrete block brick building. That's an accepted amortization period, and I see that in our school board clients. That are building schools. That's not an uncommon rate.
What's the difference?
What's the difference between an engineered structure and a building?
Engineered structures are your utilities, underground, streets, roads, streets, sidewalks, curbs.
Okay.
Bridges?
Then what are land improvements?
Playgrounds?
Oh, okay.
Parks?
That kind of thing. All right.
Any other questions?
I'm just very disappointed. I thought I had notes, but I'm flipping through here. I can't find any notes. So obviously I must not add any.
One of the easiest that I've seen to read. It's, yeah, great job, guys. I really appreciate it.
Thank you.
Any other questions?
Thank you.
It's a report back to council. What was that letter?
It's called audit findings letter, so you'll have that here within a couple of days.
And that'll be the same time that the administration receives the letter as well?
That's correct, yes.
So we have to make a motion that we accept these audited statements? Oh, okay, got it.
We'll call a 10-minute recess for a pitch. Jody's in the back.